Okay, guys, so I've kind of connected a few dots here, and credit goes out to Hi Ho Silver for bringing this aspect of it to my attention. I finally had time to look at it, and what I saw shocked me, especially when I looked into the historical data. So, what we're going to be discussing here is the repo market, the inflation risk that the Fed has been giving us for quite some time now, and we're going to take a look at some brief history as far as the liquidity crisis that we saw in 2019, right before COVID. So, and how this all ties in together. So, a brief history. Before we get into this, the term repo is just an abbreviated form of sale and repurchase agreement. And a repo market designates a mechanism used by banks to obtain short-term financing. So, in essence, a brief history from September of 2019. The U.S. Fed injected massive amounts of liquidity into banks due to a quite abnormal situation. And the abnormal situation they were finding themselves in is there was a lack of liquidity in the market, so the lenders were taking advantage of this by charging them higher than quote-unquote normal interest rates on these reverse repos. Now, while a normal rate was considered around 2%, they were charging as high as 10%. The banks did not like this because they could not obviously get as much free money as they were accustomed to. So on September 16th, the day before, of course, the banks ran to the Fed, begged them to replace the lenders, and offer them the lower rate of 2%. And the Fed agreed, I'm sure without hesitation, and the following day, on September 17th, they injected $50 billion into the market, acting as a substitute for the market. That moment right there was when our free market was taken away. And no one reported on this. No one said anything about it. The media has not said a thing about it, despite everyone in the system knowing what's going on, for the most part. So the banks are at it again. It's 2008 all over again. And let's get into the scary part real quick. So back then, $50 billion was what was injected, correct? And what we're looking at now is the NewYorkFed.org. This is a very great website to look at the Fed Reserve, what they're up to, and some of the data around it. So if we go here to the menu, we go to Markets and Policy Implementation, Repos and Reverse Repos. What we're going to do is we're going to take a look at the operations that were conducted recently. So remember, 50 billion was what was injected back then. Look at today. Today, and mind you, these are same day fixed rate loans, $394 billion. That's today. Now, if you follow this back, you can go, if you go down to the bottom and you go right here, historical search. What we're going to do now is we're going to type in January 1st of this year. And we're going to go all the way through today. And if you can't see a crisis in these numbers, I don't know what else to say. So if we export it to Excel, and we scroll down to the bottom, this column right here is the amount that was accepted in billions at that time. So we have 0.001, 0.005, relatively small. And we all know what happened in January. Now look, these numbers going up, but not that much. They're still very, very low considering what we saw today. Now, all of a sudden, once we get into that March area, after we've been, trading sideways for quite some time, there starts to show signs of a problem. Now, the problem isn't liquidity, because as you can see, there's been liquidity supplemented into the market this whole time. It's a collateral problem that is framed as a liquidity problem. So, as you can see, now we're in the middle of March. numbers are starting to rise a little bit. We're up to, at one point, 134 billion borrowed on the 1st of April. Still nothing compared to what we saw today. If you go and you come to the end of April, it starts showing signs of massive increase at an exponential rate. So we start to average around mid to high 100s. Beginning of May, we're now entering into the 200s. And then on a daily, right now, I mean, look at this, guys. 394 today, 369 last Friday, 351 Thursday, 293 Wednesday. This is insanity. So you're telling me the 1.9 trillion stimulus check that took 3 or 4 months to approve for families that, you know, may or may not have needed it, but in essence it did help a lot of people. That took, you know, Congress getting involved. It took, you know, hearings, and a lot of stuff had to be worked out to get that implemented. This is done on a daily basis. They're literally printing stimulus checks to keep this market afloat on a weekly basis without consulting anyone. I have no idea why no one's talking about this. I still need to go through the data, but I mean, this is insane. They are too big to fail, and they know what they're doing, and as soon as this comes crashing out, it's not going to be good. So I don't want to take too much more of your time. I'll let y'all go. But I'm going to dig a little bit more into this and come up with a more outlined presentation, but this is just the beginning of something very, very, very bad at this rate. Hang in there, guys.